You are watching your portfolio bleed red right now. Or maybe you already lived through it. That moment when the market drops 5% in a single day and your stomach drops with it. Your hands are shaking a little. You open your brokerage app and you almost cannot look. And then you look anyway, and everything inside you is screaming to just sell it all and make the pain stop. That feeling is not weakness. That is not stupidity. That is your brain doing exactly what it was built to do. Your brain was designed to protect you from danger, and right now it thinks you are standing in front of a predator. It cannot tell the difference between a market correction and a threat to your survival. So it fires every alarm it has, and the only thing that feels logical in that moment is to run. But here is what nobody tells you when you are in that moment. The run destroys you, not the crash, the run. And I know exactly where you are right now because I have watched this pattern destroy people financially who are otherwise completely intelligent and thoughtful human beings. People who read, people who research, people who genuinely tried to do everything right. And then one bad week in the market wiped out years of discipline and about 45 minutes of panic selling. Let me show you why this keeps happening, and more importantly, let me show you how to stop it permanently. Before I go any further, if what you are about to learn feels like it could genuinely change how you handle your money during market crashes, we do have a program linked down below in the video description that goes much deeper into everything I'm covering here. A lot of the people who have gone through it said they wish they had found it before their last crash. Not after, just something to keep in mind as we go through this. Now let me take you somewhere for a second. Picture the year 2009. The financial crisis has just hit its absolute lowest point. People who had been investing for decades are watching their retirement accounts cut in half. News channels are running non-stop coverage with graphics that look like a plane crashing. Every expert on television has a different scary prediction. And regular people just like you, are selling everything just to make the psychological pain stop. Here is the brutal part. The market was at the exact bottom. Anyone who sold right there locked in every single loss permanently. Anyone who held on, or better yet bought more, went on to see returns that changed their entire financial life over the next decade. The people who panicked and sold in early 2009 missed one of the greatest wealth-building periods in modern stock market history. The cost of that one emotional decision was not just the money lost during the crash, it was the hundreds of thousands of dollars they never made on the recovery because they were sitting in cash, too scared to get back in, waiting for a moment that felt safe enough. And that safe feeling never really came, so they waited and waited. And by the time they felt safe again, they had missed almost the entire recovery. That right there is the real cost of panic selling. And it is not just a historical story, it is happening to people right now. Every single crash cycle, the same human behavior plays out, and the financial damage is staggering. So why does this keep happening? Why do smart people keep doing this? Here is the psychology underneath it all. Your brain feels losses about twice as intensely as it feels gains of the same size. This is not an opinion, this is documented behavioral economics. It means that a $10,000 loss feels psychologically about as bad as a $20,000 gain feels good. So when your portfolio drops, your emotional brain treats it like a genuine emergency and overrides every logical thing you know about long-term investing. And then social contagion kicks in. You see headlines, you see other people talking about selling. You see fear spreading like a virus through financial media and social media simultaneously. And your brain, which is wired for tribal survival, starts thinking that if everyone else is running, maybe you should be running too. This is why the very moment you feel the most justified in selling is almost always the worst possible time to sell. Now let me flip this completely. Let me show you what actually happens on the other side of this. There is a concept in investing that separates people who build real wealth from people who stay stuck. It is the idea that market crashes are not disasters for people who understand them. They are the greatest sale events in financial history. Imagine your favorite store had a massive sale where everything was 50 or 60% off. You would not panic and throw out everything you already owned from that store. You would go buy more. But somehow, when stocks go on sale during a crash, people do the opposite. They throw out what they own and refuse to buy more. That backwards instinct is costing regular people fortunes across every single market cycle. When you stop panic selling, something remarkable starts to happen to your financial trajectory. The math compounds differently. Instead of locking in losses and missing recoveries, you stay invested through the full cycle. Historical data on the broad stock market is extraordinarily consistent on this point. Staying invested through crashes and recoveries over long enough time horizons has produced positive outcomes with remarkable reliability. The people who understand this do not just tolerate crashes, they expect them, they prepare for them, and when they come, they do not run. That mental shift alone, from crash as threat to crash as expected part of the cycle, changes everything about how you respond emotionally in the moment. Now here's the practical part. How do you actually stop yourself from panic selling when every instinct is screaming at you? The first thing you need to understand is that your emotional reaction to a market crash is not information about the market. It is information about your psychology. The market does not care that you are scared. The market does not change direction because your anxiety hits a peak. Your emotional state is not a reliable data source for investment decisions. Once you genuinely internalize that, you start to separate the two things. How you feel is one thing, what the data says is another. The second thing is having a written plan before the crash happens, not during, before. When you are calm and thinking clearly, you need to write down exactly what your response will be when the market drops 20%. Write it down. Then write down what you will do if it drops 30%, then 40%. Having those decisions made in advance removes the emotional decision-making from the actual moment of crisis. Your calm, rational self has already made the call. Your panicked self just has to follow the instructions. And this is where most people fail. Not because they do not understand the theory, they fail because they never do the work ahead of time to prepare the psychological infrastructure for handling a crash. They know they should not panic sell. They just have no mechanism in place to stop themselves when the moment arrives. People who have built that infrastructure in advance respond to market crashes completely differently. I have seen it over and over again. They go from being the person checking their app every 20 minutes in a panic, to being the person who barely notices a 10% correction because it was already accounted for in their framework. The transformation is genuinely dramatic. One person described it as going from feeling like the market was happening to them to feeling like they were participating in the market intentionally. That shift from victim to participant is not just a nice idea. It is the difference between someone who builds wealth over time and someone who constantly resets their progress every time volatility hits. The third thing is understanding what a crash actually looks like in the full timeline of a healthy market. Since the stock market has existed, it has experienced significant crashes regularly. Corrections of 10% or more happen roughly every year to 18 months on average. Bear markets happen every 3 to 5 years on average. And every single one of those crashes, going all the way back through history, was eventually followed by a recovery that went to new highs. Every single one. Not most, all of them. Knowing that does not make it comfortable to watch your portfolio drop. But it changes the narrative in your head. Instead of this crash being the end, it becomes this crash being part of the pattern. And the people who understand the pattern are sitting in a completely different psychological reality than the people who do not. When you know the pattern, you can hold. When you do not know the pattern, every crash feels like it might be the crash that never recovers, and that fear drives the selling. There is a reason that the investors with the best long-term returns are not the ones with the best market timing. They are the ones with the best emotional discipline during crashes. A discipline is not born naturally, it is built deliberately, and most people who have it did not get it from a single YouTube video. They built it through a systematic process of understanding their own psychology and constructing the right frameworks before the next crash arrived. The people who did that work are not losing sleep when the market drops 8% in a week. They already know what they are going to do. They already made that decision when they were calm. The crash just confirmed that they prepared correctly. That is the version of you that is actually possible. The version that looks at a red market day and feels steady instead of panicked. The version that knows the difference between a temporary decline and a permanent loss of capital. The version that makes intentional decisions instead of reactive ones. You did not stumble onto this video by accident. You are here because some part of you knows that the way you have been responding to market volatility is costing you something real, either financially or emotionally or both. And you know that unless something changes, the next crash is going to hit you the same way the last one did. The program we have linked down below in the video description is designed specifically for what we have been talking about today. Everything I covered here is just the surface. The full process goes much deeper into the psychology, the frameworks, and the practical mechanics of responding to market crashes with intention instead of emotion. Honestly, a lot of people think they do not need something like this because they think they already know what to do. Those are usually the same people who panic sell every single time. If you know you are ready to stop letting crashes derail your financial progress, the link is waiting for you right now.